All right, it is 11 a.m. We're going to get started in respect of everybody's time. First off, want to say thank you to everybody who's joining us here live today for another chapter of our Empowered Planning webinar series. We will try to keep things moving at a great pace for you and leave some time at the end for some Q&A. If you have any questions, please use the Q&A function that you'll find in the Zoom bar at the bottom of your screen. You can enter any questions that you have there, and we will try our best to either answer them online or reply back to you. So again, appreciate everybody taking an hour out of their day to join us here at Raymond and continue the conversation that we started back in August. So for those of you who joined us at the end of August, we did our first part of this Your Transition, Business Transition series. And this is the second part, follow-up of what we got in feedback and some questions towards the end of that in regards to some more areas of interest for the group that was attending. So quickly, today's agenda. You can see on your screen right now, we're going to kick it off with one of my colleagues who will talk about valuation and how it can be a tool as you go through any transition to help you meet your goals. Next, we'll move over into the gifting of your business. We had a number of questions about that in our last webinar, so we wanted to be a little more specific in regards to addressing that topic. And then at the end, we're going to talk about that post-transition planning. So after you've transitioned your business, whether that's to the next generation or through a sale, how do you plan for that? What does it look like? And how can folks like our advisors here at Raymond help with that? So the speakers today. My name is Eric Shoemaker. I'm a tax principal with Raymond. I will be the moderator. I've got my colleague, Greg Light, Mike McCarthy, Ryan Sullivan from our team that you can see on the screen. They will be talking through the different sections that we're going to cover here. And again, as you listen to today's webinar, feel free to shoot any questions that you have as we go through it. And we as a group will try to address those throughout the webinar. So with that, we will get things moving. And I'm going to introduce my colleague, Greg Light, here from our valuation team. He's going to cover this topic, and I'll let him take it from here. Thanks, Greg.
Thanks, Eric. So we're going to talk a little bit about valuation and how it can be used as part of accomplishing your transition goals and as part of succession planning. One of my colleagues spoke on part one of this webinar in a bit more of a high-level generic sense about business valuation. And from the comments from that, there were a few topics that were really focused on that we wanted to hit on more deeply in today's webinar. So on the next slide, these are what we're really going to focus on. And it's really the first two bullet points are related to one another, and the last two bullet points are related to one another. So we're going to talk about how you can drive value within your business, and that really focuses on the cash flow and risk in the business and how those two factors come together to give an indication of what the current value of the business is, and then how we like to look at those items to see which switches we can flip, which levers we can pull to drive an increase in value. The last two bullet points, minimizing taxes, always a goal of pretty much anyone I've ever met or spoken to, and the nuances that can come along with what drives value as it relates to the tax consequences of evaluation, and then how the discounts, and if that's something that people aren't familiar with, I'll get to those in a minute, but how discounting can factor into the value of the business and the impact on taxes. Next slide. So how do you drive value? It's important to look for the right buyer, but before you even do that, a lot of the time it's more important to look for the right type of buyer. So depending on your industry, it might be important to look for a private equity buyer that has a lot of other businesses or ownership interests in your same industry. That way, when they make an acquisition of your company, they have a lot of synergies or cost savings or upside potential that they can realize from that acquisition. And not necessarily saying they're going to pay that entire step up in value that might accrue to them by virtue of the acquisition, but it allows them to have more upside to possibly share in part of that with you. There's been some studies done that look at pre-transaction and post-transaction where there's perfect information availability, and looking at of 100% of potential synergies that were identified pre-transaction, how many or what percentage of those synergies actually occurred post-transaction. And on average, over, I think it was 95 deals or 96 deals, it was 36% of projected synergies were actually achieved. So I always tell clients of mine who are thinking about selling their business that if there's certain synergies that you think you've identified that would be existent with a certain buyer, expect to maybe achieve about a third of those in purchase price, because that's on average what's actually achieved. And anything over and above that is up to the buyer to really effectuate post-closing. This is one we talk about all the time. Do you have a saleable business or a job? And we'll get into this in a little bit about when we talk about the risk inherent in a business. But a saleable business is one that can actually be bought or sold very easily, transitioned easily enough, without getting into a situation where there's a lot of concern from a buyer's perspective that, how am I going to transition this business? How am I going to pick up the pieces if something happens to that former owner? What if I lose a key person? So on and so forth. Those are the concerns that exist a lot of the time that mean you might have a job and not a saleable business. It could be a really good paying job. It could be a job that, you make $2 million a year from, but it's a job nonetheless because it's not saleable or transitionable to the next, and I shouldn't say generation, but to an outside third-party buyer. A lot of driving value in a business transition sense is not having any surprises. Buyers love to get into their due diligence and come back and say, oh, we found X, Y, and Z. We're going to reduce our purchase offer by, $600,000, $2 million, whatever. Making those surprises, not surprises, by bringing them up front before you receive a letter of intent, when it's just in a negotiation or fact-finding portion of the process, that makes it so you hopefully have a realistic offer that's not going to change once they get into due diligence. The no skeletons in the closet, that next bullet point, that really relates to the same thing, but it can be more of the qualitative type items and not the quantitative type items. So there was a lawsuit. There was a sexual harassment case with a former employee. The things that don't show up in the financial statements, but have a very real impact on the risk of the business. So on the next slide, we'll talk about cash flow and risk and how those are the important parts of it. And
hey, Greg, before we move on, you hit on a subject that I know we spend a lot of time in our M&A practice, which I spent a lot of time working through on, that pre-deal kind of due diligence. We refer to it as sell-side due diligence. We do a lot of that work to address those bullet points that you just mentioned around, no surprises, skeletons in the closet, making sure we know what is there and what isn't there. Can you just talk a little bit about, the importance of maybe valuation as part of that kind of go-to-market strategy as well?
Yep, absolutely. So not having a valuation done in advance of thinking about a transition process, to me, I hate using cliches, but they're cliches because they're true. Failing to plan is planning to fail. And by not having all your ducks in a row and doing that planning ahead of time and knowing what your business is actually worth, you're really just flying blind. So as part of that sell side due diligence that Eric had just talked about, valuation is kind of implicit within that. There's a lot of words that go, that surround this process. There's, the due diligence, the valuation, multiples, all the different thought processes that surround, getting ready to sell a business and what might it be worth. And you really don't know what you don't know until you get into it. And by getting into this process and going through it with somebody who's done it 100 times, 1,000 times before, that really positions you to be in a position to maximize what you might get out of a transaction. If that's what you're looking to do. A lot of people are looking to gift to the next generation or sell to management, things like that. All those factors drive what we really try to do in advance of a transition. And if we're trying to just maximize sales price, minimize taxes, a combination of the two, the last bullet point here is really the most important one. What is our true level of income and expenses? That's where, as part of due diligence, there's what's called a quality of earnings analysis. That's another of those buzzwords I just mentioned. But it's having full information availability to know what you can and can't do and be able to make an informed decision. Next slide, please. Excuse me. So cash flow and risk. I used to really get deep in the weeds on valuation and talk about all these different methods that we use and rates of return and blah, blah, blah. And pre-COVID, when we do this in person, you'd see people's eyelids start getting a little bit heavy. And, you know, you can tell people are like, okay, this is too much. This is too deep. What are the real drivers? And it's really cash flow and risk. You can complicate it as much as you want, but it's those two items. The first couple bullet points on here, personal expenses, officer compensation, those really relate to the cash flow portion of it that we're trying to make adjustments for in that quality of earnings or due diligence analysis. What personal expenses are running through the business on behalf of the current ownership team? Same thing with officer compensation. We've seen $500,000 businesses where the owner is making $400,000 a year, even though they lose money every year. Then they have to loan money back into the business. It's all coming out of one pocket or the other, so they don't really care necessarily. On the flip side, we've seen businesses that are making $10 million a year in profit where the owner who's working 80 hours a week hardly makes anything. We need to right size that level of officer compensation so we get a true idea of the earning capacity of the business, because that's what a buyer is going to look at. You know, on a true arm's length basis, what does cash flow here look like? Personal expenses too, we see everything along the spectrum. It could just be a personal cell phone, whereas we've seen all the way up to, you know, personal jets and yachts and stuff like that they're trying to expense through the business. Down near the bottom, the last couple bullet points, customer concentration, key person risk, you can see that in all caps and bold. That's usually the biggest one that's important in small business valuation. And the risk that a buyer looks at is how, you know, what happens if this former owner gets hit by a bus? How do we pick up the pieces? You know, even if it's post-transaction, how often or how long do we have them on retainer to answer questions? And how long is it really going to take to transition all that knowledge base to us, the buyer? So those are the things that really drive that risk portion of the equation. So we've got our cash flow here. We've got our risk here, which is, you can think of it as along the spectrum of risk, where does any business fall? And the more risky something is, the higher the required rate of return is going to be, which lowers the multiplier of cash flow. So that's where all this stuff comes in, where we want to help de-risk a business in advance of a transaction to help have that lever effect where we're not only increasing cash flow, but we're de-risking the business. And the two of those items together really increase the value in total. Go back, last slide for 1 second. The spectrum of risk is really important. You know, we go all the way from a 1 month government bond, basically risk-free, and you get almost zero return, all the way up to an internet startup, venture capital investment that an investor might expect to make 80% a year on, because the risk is so high and so many of them fail. Most businesses fall somewhere in between. A lot of that risk and therefore required return is based on factors implicit within the company that we can't change. What we can change is the last piece of it, the company specific risk that captures all of these soft or qualitative type things that are really dependent on the specific business we're valuing. And that's what we want to do in that pre-transaction due diligence. So minimizing taxes, I don't know that I've ever met anybody who wants to pay more in taxes. So this is an important thing. It really depends on what sort of a transaction we're talking about here. For gifting or more complex estate planning, usually the focus is on discounts. What percentage of the business are we going to transfer to the next generation? Is it going to be voting shares, non-voting shares? There's all these complex estate planning tools that I won't even begin to pretend I understand, but SLATs, GRATs, I think a GRAT stands for Grantor Retained Annuity Trust. I don't know the mechanics of how it works. That's an attorney question. But all of these estate planning methods, the power in them is the discounting, or how assets can be transferred at a lower value than the overall value, because it's usually done on a pro rata piecemeal basis. On the sales side, lots of things that are dependent on the structure of the company. Is it going to be a stock sale, or is it going to be an asset sale? Is the company a C corporation versus an S corporation or an LLC? And then based on that, how do we structure the deal? Are we doing cash at closing? Are we doing like a structured note that's paid out over time? Is there going to be a consulting agreement that gets some non-purchase price cash flow to the seller over time by virtue of them being there and helping with the transition? Then also it could be they get paid for partially a non-compete or the personal goodwill that they have in the business. So we could literally talk about every one of those for an hour webinar on its own. So just trying to open up the line of conversation on some of these things and talk about or drop the buzzwords at least, so you know what to ask about in advance of a deal. Next slide, please. So last slide here, this is something that was brought up at the last webinar that people wanted to hear more about, is discounting. The two main discounts are discounts for lack of marketability and discounts for lack of control. We hear all the time how the IRS wants to get rid of discounts. They can't just get rid of discounts. I've been saying this for 10 years that they've been talking about getting rid of discounts. Discounts are not just an estate planning tool. Discounts are absolutely reality. They are pervasive in the different markets that are out there, whether it be the public markets, when someone's buying restricted stock in a publicly traded company. It exists in closed-end funds where someone is basically buying a non-controlling interest in a company that holds property. It exists as a control premium when there's merger and acquisition activity where a company is acquired for more than its current share price. That's most of that I just mentioned is on the control side, but on the marketability side, there's pre-IPO studies that are done that talk about how much less did a company or did shares in a company sell for in advance of their initial public offering, and how did that discount change over time? The restricted stock studies that I mentioned, and then protective puts, which are the idea of if my shares are locked up for a certain amount of time because I can't sell them for whatever reason, how much would it cost to protect the value via options? So all of these are very real things. These are transactions that people engage in or enter into every single day. And that's where the concept of discounting comes into this. So I don't see it as going anywhere. I don't know how it could go anywhere because everything that we base it on is based on real life arm's length transactions. So in spite of what you might hear, I believe discounts are here forever. It just depends on the magnitude of them and where we're going to get the data from it in a real arm's length situation. Happy to talk about this one-on-one. If there's anybody out there that has questions on any of this stuff, if you have questions, just drop them in the chat. And I think we're moving on to the next portion of this, and I'll be here for Q&A at the end. Thanks.
Hey, Greg, before we do move on, one common question that we get a lot, and I guess before I ask the question, I will comment on discounting. It's one of those areas that Congress in certain times and the IRS do not like, have voiced that concern, but we've never seen it go away or them enact any rules that really significantly change it. But a common question that we always get, right, is is what's a typical discount? And I know that's hard to say and I'm putting you on the spot, but is there kind of a range that you would say, given over the last maybe year or two that you've seen that discounts kind of fall within?
Sure. And a lot of it on the marketability side depends on if we're talking about a controlling interest in a business or a non-controlling interest in a business. It's much easier to sell a controlling interest in a private company than a non-controlling interest in a private company. So a marketability discount on a controlling interest is usually somewhere in that 3 to 10% range. When it's a privately held or non-controlling interest in a privately held company, it's usually more on the 20 to 35% range. And a lot of that depends on the nature of the investment, what sort of cash flow it's generating, things like that. Discount for lack of control. That's usually, that one depends a lot on what the nature of the asset is. So real estate is generally a lower discount for lack of control, usually in the 5 to 12% range, whereas an operating business is usually a bit higher in like the 12 to 18% range. I know kind of wide ranges there, but a lot of them do vary, there's volatility in them depending on where the markets are at, specifically on the lack of control portion, since a lot of that comes from these closed-end funds that are publicly traded all the time.
Oh, well, appreciate that, Greg. And there's a number of questions coming in through the chat, so I just encourage everybody to keep them coming. I'm accumulating those and we'll try to address all of them at the end. But with that, we're going to move on to our next section here related to estate planning considerations. And my colleague, Mike McCarthy, is going to cover that, in particular, kind of the considerations here as it results to transition and planning and gifting. So with that, go ahead, Mike. Excuse me, Mike, I think you're still muted if you want to unmute yourself.
Thanks, Eric. The estate tax, obviously, we're in a situation currently where there is talk of substantial changes in this area, but the way it stands now, there's pretty significant exclusions of up to $12 million on an estate. If you're a married couple with what's called portability, you can transfer 24 million of assets estate tax free. And then it comes into play when you're in that range now, but there's a sunset provision currently in effect for at the end of 2025, where we will have it'll go more down to 5 million. So that the exposure is there for estates that are in anywhere above $10 million right now. So that's kind of sets a table about what you're dealing with. The estate tax rate is 40%. It's part of a transfer tax system, which is a combined gift and estate tax. You can give away the exclusion during your lifetime as opposed to waiting to use it at death. The advantage of doing that is you're removing the growth on the gift out of your estate. And that, combined with discounts on how you package the gift or the property that's in the gift, we get discounts that Greg just spoke of, marketability, control discounts, whatnot. And those things allow for a reduction of the exposure to the estate tax and transfer tax. That being said, in the realm of M&A, when we see someone that is doing some succession planning, if it is, I'm kind of focusing on family businesses, but I will touch on non-family businesses. When you're doing succession planning and there's going to be a transition within a family, you're typically not doing a sale transaction, you're doing gifting transactions, and there may be a way that you're compensating, if needed, the generation that currently owns it, okay? They may do something with respect to splitting the business ownership into trusts or for family members, and getting discounts on their lack of control, lack of marketability, because it's split below a certain equity percentage. So in a business that will remain within the family, you really have to plan this carefully, and every situation has its own problems and unique characteristics. And there are a number of things that typically add to these to impact the planning process. Obviously, I alluded to some numbers with respect to when the estate tax kicks in and when it may kick in the future. So the size of the business in terms of value is important. Another thing that's very important is the relative value of the business interest compared with the overall size of the estate. In other words, if the business is significantly dominates the overall value of the estate, then it becomes it may become trickier if multiple family members are involved in the business, or only a few are involved in the business, about how that governance and control is affected. If we have if the value is significant and it is subject to estate tax, you are permitted in certain circumstances to pay the estate tax over 15 years. And the business interest will be held as collateral if they're included in the estate. And if the business subsequently sells, at that time, the payment of the estate tax would become due. So the size of the business is very important, but it's also important to understand that the age of everyone involved, from the generation that's giving up their interest in a transfer to those receiving it, about how much time you have, because if they give it up, the sooner they give it up, the longer the growth on the assets will be not included in a generation that owns it currently. Okay, so the longer the life expectancy is post the transaction, the more growth on those assets you're typically removing from the estate. There's I want to touch on this family situation for a moment. You may have situations where there are family members working in the business and non-family members that have nothing to do with the business. Oftentimes, but not always, the owner of the business or owners of the business want to keep the business in the family, but there is a natural tension between the one that's working on it and then the family members that aren't. If there isn't tension initially, oftentimes there's tension from the non-family members that they don't control it. They may not have the transparency they desire. From the ones that are running it, there can be some tension with respect to they're putting their time in, and they just feel like they're working for their siblings. So that needs to be worked out. I've seen it go a number of ways. I've seen it where the one running it gets more than their what would be their percentage share, dividing total the estate among all the siblings in the long run. So it can go a number of ways, but that really needs to be flushed out about what the family's desires are. Now, once that is kind of set, a plan can be put in place but you start really with what the current owner really wants to have happen with his estate. And the fact that you have the asset that may be dominating the estate just makes it more complicated than if you just had an investment portfolio. The other thing that we run into on this is that when you have a closely held business of a certain size, the larger the business gets, typically your management gets more sophisticated. And as such, they're in place and they become more of a value to the business. So there may be something that you're doing in this whole transition where you're locking them in. It may be that you do phantom stock deals, so they're not really receiving equity, but they're getting some kind of an incentive to stay. that kind of locks in some of the value that Greg referred to in his presentation. Okay, so you want to do that. You may want to do that, but it has to be considered, because a takeover by family members may not be viewed as that beneficial to non-family executives working in the business. Obviously, as I mentioned already, the size of the business in relationship to the overall size of the estate may create problems about how you're dividing up the estate among family members. It also may present problems about liquidity to pay estate taxes. I already alluded to the 15-year timeline you have to pay those things if the business is enough of the estate to qualify for that payment scheme. Without that, oftentimes we look at the potential of buying life insurance. And if it's a married couple, oftentimes we'll use second to die policies where the premium's lower, but the payout's higher. Typically the estate tax kicks in on the second death of a couple. And so there's some liquidity at that event. It's usually held outside of the estate of that generation. So the proceeds aren't subject to estate tax. So there's some irrevocable life insurance trust that we may use to create liquidity at that time. So we're not putting undue strain on the cash flow from the business and getting it distributed where it needs to go. Okay. The type of business entities involved was alluded to in Greg's portion of the presentation with respect to the complexities about how it's sold. There is also another tension. If I do gifting in a family situation, the basis of the entity in the hands of the family member doing the gifting transfers to the family member receiving it. Okay. If it goes through the estate, there's a step up to the fair market value under current law at death. They're also looking at that, whether they will keep that in the law going forward. But so there's a tension there. If I'm doing if I'm doing a transfer where it's going to the family and I am doing it to get it out of the estate prior to the death of the generation that currently owns it, I am giving up potential step up. And the step up is particularly important in partnerships, because I can actually peel away the skin of the partnership and step up the assets inside the partnership, so those inheriting those assets get to redepreciate them or write off again. Oftentimes businesses have the business entity and they have real estate in a separate entity. It typically is a partnership. So those assets are often treated very differently for purposes of how we do this planning. Okay, it's what I'm trying to impart to everyone, the planning for closely held businesses selling is very fact specific, and it's granular in how you go about doing the planning. There may be situations of potential objects of natural bounty of the owners that are peculiar. They may have marriage issues. They may have just whatever. There may be imbalance with respect to a number of grandchildren or something like that. There may be special needs. We take that all into account. It is also a time when you're doing this sale. Prior to the sale, it's obviously a time to consider doing all of this gifting pre-sale. Okay, and oftentimes it's better for valuation discounts to do it where there's a certain amount of a distance in time between doing some of these transfers into trust and taking the discounts. You don't want to do it the day before and try to explain that you're taking a discount when you knew this thing was going to happen. Okay, so these things need to be their best done way ahead of time, and it's a process. I love that Greg mentioned and Eric, the sell side due diligence. even for our businesses that are not even in this window of considering doing gifting or transferring, it's not actually a bad idea to take a look at some of the checklists for due diligence on the sell side, because basically what it's saying is, if you take care of all these things, you're probably going to have a more profitable business. Okay, so it's kind of almost like a health checkup for your business. So it's best if these things are discussed over time, that the business owner becomes very familiar with the concepts of what estate tax mechanisms we can employ. And they can be, like Greg mentioned, slats, and he mentions grats. There's also intentionally defective grantor trust. There's all kinds of things that we can use in that to bring to bear, but they're very specific based on the situation. That was a very short encapsulation of some of the issues. The biggest takeaways was, if you're even remotely starting to think about this within the next 5 years, it's probably time to start consulting with everyone on this. Typically, when you're doing this, you may start with your CPA, but you typically do get involved. It has to be reduced to writing, and there's a lot of legal work involved in this. Okay, so I would just advise you, if you're considering this. The other thing is, the insurance is also much less expensive when you're younger than as you age, and particularly if you have any, to avoid having any underwriting issues with respect to health. So just kind of think about where the business is going in the long run, start the process, become educated, and it's a better way to go.
No, thank you, Mike. And I think you hit it right on the head. It's never too early to start talking about these things and bringing the right team to the table to help you plan for that transition. So we had a couple more questions come in during your presentation. We'll try to get to them at the end, but in the interest of time, we're gonna transition over to our last agenda item, planning after the sale, and I'm gonna let my colleague Ryan Sullivan take it from here.
Thanks, Eric. Thanks, Mike. And as I'm listening to Mike, and going back to our, version 1 of this program back in August, to me, the big takeaways need to be start sooner than later with your team. So we're talking estate taxes, income taxes, business succession, family dynamics, investments, insurance, all this stuff. Bring your team together and start sooner than later. And if done right, there should be fewer negative surprises along the way. And so as we get into the planning aspects for post-sale, post-transaction, post-transition, these should all be areas that ideally you've spent considerable amount of time discussing and considering your options. And it really boils down to, or should boil down to, what do you want? So if you're selling something, you should hopefully have the option to sell or not. And ideally, you're not just looking at it from the standpoint of it's a good time to sell because the market is right, but what do you want out of this? If you're gonna sell what in most cases is your life's work, where you know how to make money, you know how to generate income, you know how to sustain your lifestyle in most cases, why do that unless you know you're going to be able to hit some certain goals post-transaction? And so today we'd like to just chat about some maybe thought-provoking questions, and then talk a little deeper into some of the specific questions and planning needs that will come up. So as an example, some of these bullet points we'll touch on today. What are some of those opportunities or obstacles when you're surrounding the immediate time after a transaction or a transition? How is this going to impact your life during retirement or post-transaction? Again, retirement is an interesting phrase. It means so many different things to different people. So, but I'd say post-transaction, how's this going to impact your life financially? What are some of those, again, areas that typically pop up that most folks are unaware of when they're thinking of planning for, in many cases, decades of life post a transaction like this? When do sale proceeds need to be converted to cash flow, or how do you do that? And that's I'd say that's one of the biggest commonalities. Is there's so much focus on maximizing the deal, all the complexities that go into a transaction, and maximizing the value and everything along the way. In many cases, this is the type of stuff, these are the topics that tend to get pushed off to the side, but then all of a sudden you wake up, proceeds are in from the sale. Now what? Where do you get your income from? And how do you maintain your lifestyle after you no longer have that typical source of income from the business in many instances? So in the next slide, we're going to get into a bit more detail on some of these areas. And as I'm going to jump around on these boxes just to entertain myself here. But if we first look at the upper right-hand corner, how should proceeds from a business sale be invested, and how is investment risk accounted for? So this is a standard question, right? In most cases, the bulk of your net worth may have been the business you just sold. Now you've taken the proceeds from the sale of this business, and you have to turn this into something that's going to, in many cases, generate income for your lifetime and potentially beyond this generation into the next. When you start to look at this, again, our recommendation is before you even talk investments, before you talk investment risk, before you talk interest rates, markets, diversification, any of that, you really need to boil down to focusing on cash flow. What are your cash flow needs? And when you're planning decades out, 20, 30, maybe even 40 years or beyond, what are your cash flow needs? And then backing into the interest rate return you're going to have to generate. And as you identify that, then you can start talking about what are the types of investments that would make sense? What's the type of risk you're comfortable with? We're in a unique period right now where we potentially could have higher inflation, but we have very low interest rates. Equity markets, outside of the last month or so, equity markets are still at very expensive prices. So if you were closing on a transaction today and then tomorrow you had to figure out what to do with the proceeds to sustain your lifestyle for the rest of your life and beyond, what would you do? Buy into a really expensive equity market, buy bonds at historically low interest rates, paying you almost nothing, and in a rising interest rate environment, but you also have inflation. So as you think through this, you're really going to want to focus in on what are your cash flow needs? What is that rate of return that you need, that minimum target rate of return you need to accomplish the lifetime income goals you have and the legacy goals that you have? And then focusing on what are the historical averages, both for return and volatility, that a portfolio mixed of fixed income, cash, equities, alternatives, and these different core asset classes, what is that proper mix? And most investment advisors or wealth management providers should be able to provide you with a historical perspective as to what a portfolio can look like. Not that is going to be indicative of future returns, of course. But again, take a step back, focus on cash flow before you get excited to buy into some abstract investment. Dial in on your cash flow needs, back into that target rate of return, and use that as maybe your starting benchmark for what you need to accomplish. Additionally, and this is usually an area that tends to get pushed off as well. So you've got this business, you sell the business, you may have a qualified retirement plan, in most cases a 401k. What do you do with that? And that might be a substantial piece of your overall net worth. And 401ks and IRAs have a unique space in the planning process. So initially, if you look at your 401k, you might be forced to distribute your 401k balance as a matter of the transaction. In some cases, you might be able to maintain your balance in the 401k. If you have that option, before you just automatically roll that balance into an IRA, you should strongly consider what are the benefits of your 401k. There might be some substantially reduced fees as part of the 401k. You might have lifetime guaranteed income options in a 401k that you cannot find the same outside. You might have better cash investment options in your 401k than if you roll it into an IRA or a similar account. And then there's also the rule of 55. So for folks that are under age 59 and a half, which is where, excuse me, you can access IRA distributions or 401k distributions and avoid that 10% early withdrawal penalty. There's also the rule of 55, which is incorporated into some 401ks, where you might be able to take distributions out of your 401k pre-age 59 and a half and avoid that 10% penalty. IRAs don't have that. And so that's something that, again, take the time, walk through the benefits of your qualified plan, your 401k, before you automatically roll it into an IRA. And again, as part of most planning processes, this should be laid out to you before you make that election to facilitate a rollover. But again, potentially great benefits in your 401k that you can't replicate outside in an IRA. Additionally, you find these transactions where there might be a period of a year or two or more where there's spiked taxable income, right? There also, in many instances, are periods of years where you have dramatically reduced taxable income because all of a sudden you've got this net proceeds after tax that you don't have the same level of income or distributions you were generating from the business you just sold. Potentially, this could lead to a great opportunity if you have IRA dollars that you haven't paid taxes on yet, converting those into a Roth. That could lead to more efficient use of your total net worth as far as estate planning and legacy planning goes. It could help with future tax planning. But again, a Roth conversion can be a very useful and efficient tool, taking advantages of those years where your income is artificially suppressed post-transaction. So again, great cash flow planning, focusing on taxes as part of that, might identify these moments in time where you can do some really unique planning that's very effective if you have, those opportunities. So consider Roth conversions. Again, it can be very impactful for both future income planning for you as well as legacy planning for the next generation. Income guarantees. So another piece of this, and then we run into this all the time, is, should you look at an income guarantee, and it's either fixed income, annuities, and those types of investments. Right now, we're in such a low interest rate environment. The key piece here is compare it to what you need for your cash flow goals, and are you willing to give up control by shifting risk to an insurance company or a bank that's guaranteeing that. The biggest recommendation here is just make sure you're comparing that side by side and incorporate taxes in, and also flexibility. So when interest rates go up, are you locked out of being able to take advantage of those interest rates 2, 3, 4, or 5 years from now? And in close, as we're coming down to the wire here, I think the big piece on the next slide that you'll notice is really taking a step back, focus on, again, what is that target rate of return? Is your goal to just accomplish that and with the least amount of risk, which in many instances that's the target, or are you looking to identify, look, I've got more than enough to cover my lifetime goal of income. I'd rather look to generate additional wealth to transition to the next generation. And those might be two distinct strategies. So focus on protecting your income and then looking at that long-term legacy planning beyond that. But again, good cash flow planning, detailed tax planning should help you identify what is the true risk of outliving your money. And that's, in the end, the typical concern most folks have now is, am I going to outlive this money if we're planning to live all the way to 95 or beyond? So good planning should help identify these risks, and good planning should help mitigate the chance that they occur. So, and again, any questions you have, let us know. But cash flow planning, tax planning, bringing your team together and starting this process sooner than later, and this should be a foregone conclusion by the time you complete a transaction.
All right. Well, thank you, Ryan. We've got a handful of questions that have come in for those who are still, attending. If you do have any other additional questions, please submit those either through the Q&A or through the chat, and we'll try to get to them. But with that, I've got about, a decent amount of questions actually that have shown up, and I'll start rattling them off, and I'll just ask if the presenters could come back on video, and we'll take this as a group. So first question, and Greg, this probably relates mostly to you. The question was around kind of how our business is valued. Is it more typical that they're valued on a multiple of EBITDA or some, times revenue or other? And I guess I'll let you, Greg, take that question here initially.
Sure. So it really depends on the industry if there's any particular rule of thumb. So like accounting firms, for example, or other professional services firms, a lot of the time are valued as a multiple in the low 1.2 times revenue. Automotive dealers, for example, are valued on this concept of blue sky, which is the term for goodwill and intangible value. That term is only used in the automotive dealer space. And that's usually fixed assets, tangible assets, working capital, inventory, plus this multiple of earnings that adds on that quote unquote blue sky value. So there's no real single clear approach. in general, you can back into multiples of EBITDA are usually a good way to compare company to company across industry. But the way you actually get to that value initially is not always as simple as that. Sorry, kind of dancing around the question, but it's not that easy, unfortunately.
Well, and I think it also kind of depends on what's the market that you're entertaining the transaction in, right? I know, so my background in the private equity space, it all tends to be EBITDA based multiples in general, and you hear a lot about that in the news or out in the marketplace, but that's not always the most appropriate way. Again, depending on what your needs are, what you're valuing the business for, what kind of transaction.
Yep, and oftentimes that EBITDA multiple is used as a shortcut to make it easy to talk about. If you're at an industry conference and you say, somebody says, oh yeah, we got an offer to buy our business at 7.5 times EBITDA. That's a lot easier to say than they did a discounted cash flow method where they had our cash flow projections going up by 47% over the next 5 years. And they were doing a weighted average cost of capital of 12.7%, which led to a multiple of 7.5 times EBITDA. So that's where it's a communication device a lot of the time, as opposed to the method that's used to value the business at the outset.
Yeah. Thanks, Greg. All right. Another question here, and this is an interesting one, and I'm sure we all have some comments for it, but question was, are you seeing more businesses selling in the market or transitioning to next generation when you compare it to maybe historical experience? I don't know if anybody wants to take that first. I can kind of comment. In the current environment, from my standpoint, it seems to be that we're seeing a lot more of the true sale transactions, at least in our M&A, merger and acquisition services group. Very high valuations out there for businesses. And, I can think of at least 3 instances where we had family businesses that were initially thinking about transitioning, and then either through a test of the water, see what the market might put a value on their business for a sale, or unsolicited offers from competitors or strategic buyers have kind of pushed them into that sale transaction, as opposed to just continuing down their initial path of kind of transitioning. So I'd say in general, from at least my experience, and again, I'm probably tainted because I spent a lot of time in our merger acquisition group doing transactions, true sale transactions. Anybody else have a few comments?
I do have a few comments. First off, 08-09 downturn kind of woke a lot of closely held business owners up about the real risk that's out there if the market goes sideways just before they are looking to exit. So it kind of woke them up to the fact that whatever happened in the last 10 years could change on a dime. It was pretty rough. So there's a lot of things, once that corrected and those that survived got out of it, we're looking to get out. Interest rates are extremely low, which makes buyers financing of these sales, particularly private equity, who have access to large amounts of investment money. It makes it a nice time to do this. Okay, they're looking at it from a long-term perspective. So this COVID was the second thing since 08-09. So a lot of business owners are just kind of saying, I just don't feel as sure about things as I did before. And these prices that I'm getting, that they're offering, seem pretty reasonable. So I do think that that's prompting it also. You got I'm at the end of the baby boomer kind of thing, but a lot of the baby boomers that grew these businesses are now, they're looking at, their age, it's just time. So I think there's a lot of activity in M&A, and I think we will continue to see it on a regular basis.
Yeah, I would agree with Mike, and I think we're starting to see that also with younger business owners as well. So it was clearly a trend in the baby boomer generation, just naturally due to their kind of the stage of life. But then it's that what it takes to run a business these days with COVID and protocols related to COVID and everything that comes with that. I think many business owners they've just changed their desire to do that. They're tired, right? And they don't necessarily want to do it any longer. But yeah, as long as interest rates are low, there's so much private equity cash on the sidelines that has to get deployed at some point. which is almost self-fulfilling, right? Because a lot of that's baby boomer money post-transaction that's now kind of driving the demand to buy businesses. But yeah, it's kind of that perfect scenario for many folks. So yeah, I would agree. I think that the trend continues for a while now.
All right. Moving on to another question here. And maybe Ryan, this was sparked, I think, by your portion of the conversation. You know, and I'll paraphrase the comment that came to me, but you know, when is the right time to start talking to somebody about your post-transition needs? And kind of this is they elaborated, and this is very common. I think we hear it in our client base quite a bit. You know, hey, my wealth is all tied up in this illiquid asset, this business that I'm operating. I don't plan on selling in the next 5 years, 10 years, or at least I don't think I'm going to. You know, why do I need to talk with a financial advisor or really start to think about this, right? I don't have anything to play with at the moment.
Well, I think great question, by the way, and that's a very common question. So, the misconception is that you have to have like liquid assets to invest in order to make financial planning make sense, really. I mean, investments are just the tool, the mechanism to help satisfy your goals and help manage risk. It really shouldn't be a limiting factor. And that's extremely common. So what we do find is if you start planning earlier, thinking ahead about what you want allows you to structure your business, position your business, make strategic decisions related to your personal finances and your business. So it puts you in the best position possible, because in most cases, when the right deal comes along, it usually isn't structured as, okay, today I'm ready to go. Let's find that buyer and you get the best deal. It's usually a knock on the door you weren't expecting, or you normally don't open that door or take that call, and all of a sudden game on, and it's 90 days later and this thing's closing, or whatever the case. So planning years in advance, because you don't know when the right deal is going to come around. You don't know when you wake up that morning and you're just ready to be done. But planning ahead will put you in a better position of leverage, versus if you get to the point in all your net worth, or 99% of your net worth is tied up in the business, you haven't done a good job of taking distributions, building your personal balance sheet outside of the business, building up your 401k balance, something that's away from the value of the business, driving your total financial success, that gives you flexibility to be patient and do the right deal versus having to rush it, right? And although we might be in a great market today for many industries to sell, there's plenty of times where all of a sudden you overshoot it and you don't get the deal you want, and all of a sudden you have to sell. That's not a great place to be. So planning years in advance, and it might not require annual planning or quarterly planning, but maybe every couple of years, building a plan and then monitoring it with the right team of professionals can help put you in a better position when the right deal comes along.
If I might add, if I have a client that has like all their eggs in one basket, which is their closely held business, I'm looking at advising them that you really do need insurance, and you also may want some kind of a buy-sell agreement with someone in management or something with predetermined method of valuing it, or maybe a right of first refusal kind of thing, just to make sure that it's thought out for the family and how they would deal with it, and you have your advisors and your legal team aware of what would happen in case of a tragedy. Okay, so you're really putting your family in a bind, particularly if you are a key person in the business. You know, you just really, if that's the case, you have to be really careful about how this is going to go. You may think, like Ryan said, you're going to get out and you feel like getting out, but that's not always the case.
Yeah, thanks for those comments. And before people start to jump off here, we're coming up on our noon hour here in the Eastern time zone. If we have, I think, one more polling question, or a polling question for the attendees, just to help us make sure that we're providing information that's important to you and what you're interested in hearing more about. So if you could take a moment to do that. And while people are doing that, there was one question I know that came through the chat, in addition to some others we won't be able to get to here, but we can follow up as needed. But it was in regard to maybe a little more specifics of, you know, when is the right time to go to market, you know, an automotive manufacturer with the chip situation that's going on. And I just wanted to comment, you know, it's different for every business. in that situation, the chip shortage that everybody's dealing with right now, the more and more I hear in the public space and in the market, it doesn't sound like that's something that's resolving itself in the near term. And I don't have a crystal ball, nor does any of my colleagues that are here on this call to say when is going to be the perfect time for a business like that to go to market. But it's really that story, and preparing sooner than later and working with your team of advisors to help come to that conclusion of, is now the right time? Or is it worth testing the water and seeing what that looks like, and helping add some clarity to that? There's no crystal ball to say, hey, if you do it in the first quarter of 2022 versus the second or third, it's going to mean drastically different things for you. But the base step, I think, as Ryan was really hitting on, is really understanding what does it mean for you, at whatever value you might be able to obtain, and how do you plan for that. So, well, with that, I'm going to say goodbye to everyone, and we thank you again for taking time out of your day to join us here. Look for future webinars coming from Raymond on topics that we believe are important to you, and we appreciate your attendance. As you've seen in the chat, the recording for this, as well as part one, there's been some questions about where that might be located. Those are available out on our external website, raymond.com. You can find that, and I believe there will be a follow-up email to all attendees with copies of today's slides and a link to those recordings. And with that, we will let everybody get back to their day. Thank you very much for joining us. Best of luck here as we finish out the year. Bye.